The question is, I was wondering how much cash you usually like to keep on hand, or if it is more situational. I think the appropriate answer to that is probably yes.
I
um,
think, yeah, I think
but
it's very
definitely
important to
depends
have.
on the person, right? Depends on the
Yeah, it
individual.
does. It does. I mean, obviously, if you're in your 401k or 403b plan and you're just going into mutual funds like the S&P 500 mutual fund, you probably don't, it's not worth necessarily having cash or trying to get cute with it. Don't try to time the market because you're going to be buying every month at highs and low points. And over time, as long as the market climbs, your cost basis will be lower than that. When you start getting cute with your 401k and 403b plan, then you can miss huge moves because you thought you were smart, you went to cash, and then we rallied, and then you're like, oh, well, now what do I do? When do I buy? So in those kind of situations, I would just run fully invested, knowing that every pay period you have more money running in. I have most of my money in a SEP IRA, which is a type of IRA that business you can use for businesses. So there's always cash in an account that I can transfer into that as long as I don't exceed the regulatory maximum, which I think is like 55 grand a year or 20% of your net income. I think double check these numbers, people. I'm not an accountant, but I can transfer money into them that way. But in the account, I will situationally rotate my cash up and down depending on what the research is telling us. Free trial below. So if the research is getting very extended, if my gut is starting to keep me up, wake me up early in the morning, if I just feel like we've had a big move and we're at risk, I will sell into the strength. And I have no problem going up to 20-30% cash in those situations. Then as we get an opportunity, redeploying that money into whatever's high scoring in the research or whatever I'm finding on through FinTwit or through my other services or anything else, to get myself back to mostly fully invested, which is where I sit today. And this is actually really timely, Joe, because I've been actually modeling how I want to play out for the summer. And, I'd raised some cash and then I deployed that last month. We've had a nice lift again. And I think I'll probably be raising cash in another couple of weeks. So I'll probably be looking more at places where I can free up some cash and rebuild that dry powder for another leg down, maybe in the late summer or early fall, which is seasonally what tends to end up happening with the markets. They tend to get sluggish in the summer months and then put in some sort of an actual bottom, say in September or early October. So that's kind of how I'm thinking about, and that's kind of how I think about cash generally.
Yeah, I think that's helpful for people to hear. We've talked a lot about seasonality in the past, and so I think it's probably safe to say that's more or less your biggest overall factor in your cash position. Correct me if I'm inaccurate there.
It's a little bit inaccurate. I mean, I will use it, but it's certainly not the only thing, the only reason that I would raise cash. Like in February of 2020, seasonality was excellent.
Right.
You should have strong seasonality through spring. But I went to I think I was like 50% cash by the end of February. So I'd say it's data dependent, depending on many things. It can be seasonality. It can just be your gut. It can be, when you see speculative frenzy, there can be any number of reasons why you do it. But I think that the important thing for me is that as you get your legs underneath you as an investor, if you're actively investing day in, day out, watching AMC trade like a maniac or whatever, you start to get a sixth sense, if you will, for when things are just too easy.
Right.
And when it's getting too easy to make money, that should be kind of a signal to you that, oh, well, this is getting a little bit probably frothy and we're due for, some form of a pullback.
Yeah. Can I pick your brain a little bit more on your move in February 2020? Because I think that's really, really interesting that you had that much foresight into kind of what was coming. Like, were was it entirely pandemic related? Like you
No,
saw no.
no,
So what was it then? I'm
no. You know
now
what it
I'm even
was?
more curious.
Yeah, because I think if I go back to 2020, I look at my trade logs. I actually started, it was late January. So yeah, we kind of were getting an inkling that there was some sort of a COVID thing, but I don't think that really that was weighing on people as much until probably mid-February. For me, Joe, it was our overbought, oversold indicator. And I talked about anchoring, and then, like, now we've kind of dislocated from what would have got me to sell, what got me to start raising cash in January 2020 was that we were banging on, I think, 50% of the universe trading more than 5% above the 200-day moving average.
Yep.
And going back to 2013, the only other time that had happened was 2018, when we actually put in a peak and had that sharp sell off in the November, December, and then January, I think, of 2019, we started to rally again. So I was looking at that and saying, yeah, we are frothy, we are overbought, and I am nervous about it. So I was already in the mindset to start raising cash. And then of course, maybe COVID accelerated, my decision to do that. But it wasn't at the beginning of it wasn't what instigated the move.
Yeah, interesting. Well, it certainly certainly saved your behind at least somewhat.
Yeah, and
Getting
it gave me some great entries. I'm not gonna
yeah,
lie. I mean, I was buying with bull. There's a tweet that I did. You can still find it in March, mid-March of 2020. I was like, put some money, any money, a little bit of money, spend some money, buy some of these stocks, because the amount of fiscal and monetary stimulus that's going to be coming because of the COVID shutdown is going to blow you away. It's going to blow your mind. And absolutely, that's what happened. And it wasn't rocket science. I was just looking back to 2008, 2009, and having survived that mess and seeing how, in 2008, they were still trying to figure out, do we let companies fail? Do we not let them fail? Should we really be pressing on the accelerator? How hard should we be pressing on the accelerator? And I just, in my bones, knew that, hey, those lessons were learned in 2008, 2009. They're not going to mess around. They're just going to go in guns blazing and prop up this economy. And sure enough, that's what would have happened. But it wasn't because I'm some sort of brilliant tea leaf reader.
yeah.
Right?
Todd's not a wizard. He
Yeah.
just he got a little bit lucky, and yeah, knew, kind of had just enough foresight, but not in any sort of witchy wizardy way.
No,
Believe me.
that was just a matter of having been there, done that, and survived through one really crazy period, and thinking, oh, what's likely to happen in DC this crazy period.
Exactly.